Longer term, oil has recovered from that late winter swoon. It's been up nearly 20% since the start of December. Joining us for more on that is Jeff Currie. He is Goldman Sachs Global Head of Commodities Research. And Jeff, we saw that huge swoon in oil prices when it looked like Omicron was really coming to the fore and could potentially start shutting down things again. You at the time said that this was one of your top recommendations for 2022 was to buy these commodities dips because you saw it coming roaring back. Did you think you were going to be this right this quickly, though?
Oh, the fundamental setup in these markets is incredibly strong right now. I mean, the dislocations across oil, copper, and the rest of the commodity complex are record levels. Just take oil. Right now, today, it's in a 2 million barrel per day deficit. That's 2% of the market that is missing. Inventories are now 5% below the 5-year average. So the fundamental setup is spectacular right now. And then that's not even to say anything about the financial setup. Investors don't like this space. The overall participation is quite low. And then you look at it in the context of the financial markets. Equity, price earnings, the PE ratios, very stretched near record levels. Interest rates incredibly low. You have high convexity to bond prices. So what you're left with is financial markets really exposed to the downside, particularly given the fact you have a Fed pivot. Commodities, we argue, are the best place to hide in that kind of environment right now. So we think not only do you like commodities from a pure return basis, but also from a hedging basis.
So we've seen this huge move, but you don't think that this is the end. You think there's more to come?
Oh, we argue this is the beginning of a commodity super cycle, or at least we're about a year in it. We first forecasted a commodity super cycle in October of 2020. Now, you go back that far, the situation is far more bullish than what we had originally anticipated, but all the structural support for that type of bull market are in place. We call it the revenge of the old economy. You know, structural underinvestment and the ability to supply and deliver these commodities. This is something you don't fix overnight. And then you have the ESG factor overlaid on top of that, which makes the market struggle to attract capital. Just look at energy shares relative to the oil price. They've struggled to keep pace, which means that the elasticity of supply across these markets is unprecedentedly low, which means you're not getting a supply response. At the same time, demand does not look like it's going to slow down, whether if it's oil, copper, or the rest of the commodity complex.
What's a super spike mean? What are we talking in terms of prices that you might anticipate over the next 3, 6, 12 months?
We would argue that the metals are the primary benefactor of this super cycle, unlike oil was back in the 2000s. And the reason why is the green CapEx story. In terms of thinking about, you have every country in the world pursuing the exact same policies at the exact same time. And there's no way you're going to decarbonize the world without copper. Copper is the strategically most important commodity out there. And we like to say copper is the new oil. And their inventory is dropping like a brick, inadequate supply already. And we haven't even started to decarbonize the world. So copper is the one that really benefits from that story.
Jeff, kind of taking the derivative plays out of this, moving beyond just commodities, which I know is a little outside of what you'd focus on, where could the potential problems come? Like what would be something that could pose a problem that other people haven't figured out just in terms of the supply chain?
Well, in terms of resolving the supply problem in oil, the oil's there. You just got to get money to where the oil is. And that's really where the struggle becomes from. So I like to say it's not about the supply and demand of the barrels of oil or the metric tons of copper. It's about the supply and demand of the dollars used to create that supply. And the problem is right now you have severe impediments. In metals, it's the governments in places like Peru and Chile are making it very difficult for companies to make large scale investments. And then when you look at places like the DRC, which is where a lot of the world's copper is, it's very difficult for companies to want to make capital investments there. And then when we look at oil, you have ESG impediments that make it difficult to attract capital. So the net of this is, the commodities are out there. The problem is getting the dollars to where these commodities are to produce them. And that's going to take time. On the demand side, it would take an outright recession. Here's a really important point about the demand for commodities. It's not the growth rate of demand that matters. It's the level of demand. That makes them very different from financial markets. And the key point here, if the demand level is above the supply level, I don't care what the demand growth rate is. It could be going down, It could be going up. As long as demand's above supply, I'm bullish. That's what creates diversification against equity markets.